Good morning, everyone. And for those of you who are not able to attend today, we appreciate you kind of tuning in, listening. Those that are here, hopefully, this is very impactful for you. And I wanted to take a minute here to kind of talk about the purpose of this and why we're doing this. And then I'll introduce our guest speaker today, who's got tons of great information for you guys that are either watching the recording or are here live, right? So, December is such a good time, right? And so many people I've heard either look at this as like, man, there's such an opportunity to set up our businesses for success for the next year, or are like, you know what, David, I'm, kind of clocking out and I don't really pay attention until January. One is significantly better than the other, and especially as it relates to establishing and starting to prepare some tax planning strategies for the upcoming year. Now is the time. Right now is the time, not only from a business planning standpoint, but the tax planning standpoint. And we're focusing this morning on the tax planning standpoint because, like I said, if you are growing and scaling your business as you absolutely should be doing, preparing and strategizing for some significant business growth, guess what, guys? Your taxes are going to skyrocket. I mean, that's just the way it works. If you're making more money and you're increasing your profitability as you can and should, and taking advantage of so many powerful business opportunities out there, you need to do some tax planning or you're just going to be giving a big piece of it back to the IRS, and that doesn't make any sense at all. So I have Mr. Tae Kim with us this morning. He is a very accomplished CPA. He works, not only locally, but much broader than that. And I've had the pleasure of working with him now for quite some time, and he does an amazing job for his clients. And so very, very knowledgeable here. He does a whole bunch of different things, but I'm going to let him kind of introduce himself a little bit further. But thank you, Tae Kim, for joining us. And floor is yours, my friend.
All right, thank you, David, for a generous introduction there. Yeah, hi everyone. My name is Tay. I'm a CPA here in Murrieta. I Just a brief introduction about myself. I've been working in the accounting industry since really the start of my career, since early 2014. Jumping back and forth in between different accounting firms in both local, regional, and national public accounting firms, helping with tax returns, accounting, finance, financial reporting for many different types of many different sizes of business owners. I always had a passion for especially small businesses and just making an impact on the local business owners. And quite honestly, when it comes to running a business, tax time is always the worst time of the year, right? Because we always pay tax. If you were an employee, your taxes are taken care of by the employer. You got your withholding there for you, but year end is always the hard time for the business owners. I don't want this meeting to ruin your holiday season, obviously. I don't want you to spend the next 4 weeks in agony thinking that, oh my goodness, I have all these tax liability I gotta worry about next year. But the main part of this call or this webinar for today is just to just bring some more importance to your business cycle, because right, as long as we're living and operating business in California state, right, we're gonna always have to deal with either federal or state or both income tax situations, unless you're Elon Musk or Donald Trump, then you're in a different story there. But as long as we're business owners, this is something that you will have to address. And my mission here is helping clients to really be proactive when it comes to tax situation instead of being reactive, right? So that's where my main focus is in my practice here. I've been last year. I have decided to leave my job and go full speed at serving clients in Temecula Valley and Murrieta as well. And so it has been a really, really, really evidential blessing for me and my family to be able to continue to grow my practice and serve clients here. And I personally like to give a very specified, tailored, and honest tax advice. As much as I make a living doing this, also I need to make sure that the clients who are benefiting this are actually benefiting from this, not just paying someone a fee and moving on, right? So that's where our main focus is. Yeah, so looks like David had some polling questions lined up. I just want to gather some information from the audience today, just so I can get some better understanding. So yeah, David, go ahead and release the polling questions there. And as I go through the slides, I could get some better information about the audience, so I could tailor, the content, the topic today that's more applicable for everybody.
Perfect. Hey, yeah, great. So, guys, I'm going to try to make this as interactive for you guys as possible and as if we were just sitting in the same room together. So, there's going to be some polls that are going to pop up. You just, everything's anonymous. Don't worry about it. So, you just kind of click your answer, and that way, Tay can get to know you and your business a little bit more, like I do. And then, also just some logistic kind of administrative kind of pieces here. If you have a question, okay, if you go to the bottom and there's a Q&A button, you can submit questions to me. Now, Tay's going to take questions at the end, but if there's something like really impactful to what he's saying in the moment, I may interrupt him gently. But we'll take more questions at the end. That's your opportunity to submit questions to him. And then also, if you have something, actually, I would just say, just do it like that. Just send me the question in the Q&A button. You could also send me it in the chat if you send a message to host/panelist. You can do it that way. So if you're having trouble with the Q&A button, then just do it that way. Okay, so I think that's our housekeeping. And okay, let's go ahead and fire off our first question. It should pop up on your screen. So, okay. We'd like to know how your business is structured. Okay, so you should see the poll now. You have S corp, C corp, LLC, sole props, or if you have multiple companies, you can just answer for your primary entity. Okay, your primary entity, right? In the event that you have, I know a number of you have multiple businesses. So, okay, so you can see Tay. Can you see the answers? Okay, perfect. Okay, yep, you can see them. So S corps are running away with it. So there you go. Okay, all right. So yeah, 4 to 5 at least have at least one S corp, and one person has a multi-member LLC. Okay, so that is that one. Now let's drive this a little bit further. Let's pop back up here. If I can figure out how to do the. Oh, here we go. Oh, I got in the poll. Okay, there we go. Okay, so we got that. Let me do another one.
Now, David, real quick here on the previous polling, were there any C corporations?
No C corps. We've got 4 S corps and 1 partnership LLC.
Got it.
Okay, here we go. I'm figuring this out. I haven't done a Zoom webinar for a little bit. I've used other software, so I'm kind of okay. So, guys, let's talk about your experience with tax planning. Okay, so you should see the poll up on your screen now. Feel free to check the box for what fits you in terms of your experience in developing tax planning strategies with a tax planner. Okay, so we've got everything from very experienced, somewhat experienced, familiar with some of the strategies, but not very many, or, guys, I'm just not very familiar with it, or what's tax planning? Right? So we got a pretty even spread from the top, kind of going all the way down. Tay, can you see that?
No. Go ahead. Oh, here we go. I see it here. All right, perfect.
Okay. Awesome. So pretty good spread here in terms. So guys, when he's going through this stuff, feel free to shoot some questions if you got them, so you don't forget them, or just, then at the very end, we'll take the questions there, because we want to make sure you guys get a ton of value out of this. Okay, for that will act, like Tay said, will actually significantly make an impact in your business, because yes, we can increase profitability by efficiencies and reducing costs and that kind of stuff, but you can also increase your profitability just by paying less taxes, right? So, kind of two different ways to do the same thing. Okay. All right. And then our last poll is how satisfied are you with the taxes that you're currently paying? Okay, and be honest, right? Are you like, you know what? I'm kind of comfortable with it. I'm kind of here for a refresher, or man, I am getting annihilated and I need some major help. Right?
But, I mean, David, come on, we're all not satisfied, right?
Good. Yeah, no, good point. Good point.
Yeah.
Yeah. Yeah. If we can legally, ethically reduce our tax liability, why wouldn't we do that? Right. So 100%. I think so far 100% of our audience is developing and executing tax planning strategies in 2025 is a huge priority. Huge priority.
Okay.
So guys, you're in the right boat here. And then one person said, you know what? I'd like to reduce my tax liability, but maybe it's not at the top of my list, but I do want to do it. Okay. So no one in the room, and I would put myself on this list as well. I would probably on the bottom of this list too. Like, man, I need to execute some stuff. But no one is satisfied with the amount of taxes that they're paying. I mean, like you said, nobody should probably be in that bucket, but everybody's wanting to execute some stuff. So I think we're in a good spot. So perfect. Okay, so that's our polls. Thank you for participating. Tae, they're all yours, my friend.
Great. Thank you, David. Just real quick here on the second poll, what were some answers there? Or do we have some folks with tax planning experience, or is this more of a new topic for many people?
Yeah, it was fairly spread. It was basically almost one in every category, from
Okay.
somewhat
All right.
experienced all the way down
Okay.
to the what's tax planning.
Okay. Great. So we're even here. Perfect. All right. So let's jump right in here. Do, everyone can see my screen?
Yes, I can see
Okay.
it.
Perfect. All right. So yeah, I just wanna I don't want to get too much details on, A, B's, and C's of tax planning, but I do want to address, just a few major topics and just really give you a full perspective on what tax planning is. Before I jump into this, uh, tax, like we mentioned earlier, tax is always going to be there. However, I want to just remind all the business owners that tax is not something that you should think about 24/7, right? You know, we all have our own expertise here, right? And so that's where we spend most of our energy, um, you know, and you do what you do best at, right? And if David's a great attorney, that's where most of his energy and time and effort goes in to grow your business, the top line, right? Your revenue. Honestly, because I have seen so many different cases of business owners, some owners. I think that's one of the reasons why a lot of the attendees here today are answering the last question on the last poll. That many of you are spending a lot of your energy on the top line, the revenue, and so tax is great, but hey, I'm still running my business, I'm growing, but it's something that I need to work on, which is great. So that tells me that a lot of you folks do not want to stress out about tax all throughout the year, right? And you shouldn't. And so just wanted to put that out there because sometimes I see some business owners that stress out so much about tax planning all throughout the year. They want to do this and that and everything, and then you forget to actually grow your business and you spend time and energy in growing your business, that you allow the tax situation to pull you down. So I just wanted to put that out there. All right, great. So just for some folks who don't know what tax planning is, um, in the old days, the word tax planning didn't really exist. Let's just put it that way. The older folks, the CPAs and accountants and enrolled agents and tax professionals, just did what they can do, and uh, it kind of just, hey, hey, it's tax time. I take my documents, I file my tax return. whoa, it's a good surprise. I get a lot of refund, or oh, it's a bad surprise. I have to pay a lot. And that's been, happening for many, many years. And now recently, the tax planning has been revealed more and more to the general public. And one of the main reason is the COVID, right? Because a lot of the people started receiving um, unemployment compensation from EDD, which is not taxed. You started having more side gigs. You started getting more 1099s, and more people started paying more tax uh, from result of getting more 1099 income, right? And so it has been a growing pain for a general public these days. And so really the need and importance of tax planning started to surface a lot more. Bottom line, when it comes to tax planning, really it means no surprises. Okay. Going into the end of the year, if you have a solid tax plan, you have two things. You have built a strategy to save tax. That's one part of the tax planning. The second part of the tax planning is you know approximately what your tax result is going to be going into the tax season, right? So there are no surprises. You can plan ahead, right? Or if you want to build a different plan, build a different strategy, you have time to do so, right? So when it comes to tax planning, it's not, we hear so many things, and I'm sure I'm not the only one, but there is an overwhelming load of information these days about tax planning, tax saving strategies that is just really thrown out to your face right there, either through TikTok, Instagram, YouTube, your family member or friend from church, anything, right? Hey, I've heard this and that, and you could do it this and that. Um, you know, not all of that answer is wrong, actually. But the problem is finding out which of those strategies are the ones that actually work for you and is actually worth your time and money that you spend in order to get that tax saving, right? Most common mistake that I see people make is S corporation, right? Because there is a widespread word out there that S corporation is great, it's always the way to go, and you jump in too soon, right? If you're a single member LLC, if you're a sole proprietor making $30,000, $40,000 a year, who have not done a reasonable compensation study to begin with, and to find out, is my S corp really going to help me save money or not? Because once you commit to forming an S corporation, I'm sure after working with David, you know by now how much of the legal, right, administrative documentation and paperwork that you need to have in order to have a legitimate business entity, right? The same goes for accounting and tax as well. You need to file a tax return. You need to have a set of books for your business. So there's a whole new set of requirements that follow by jumping in too soon with the S corporation. So you need to always look at you as an individual, as a business owner, and your financial situation. And sometimes I also ask for, part of your, just getting to know a person really is also important. Some folks are saying, hey, you know what? I'd rather just pay my tax and go enjoy my time in Hawaii or something. And if your after tax saving is sufficient enough. But some folks will want to really spend every drop of their energy to save a money on tax, right? So it really depends. So you have to do a full analysis of your financial situation. How is your entity formed? What's your structure, right? We have one multi-member LLC. I'm sure that's going to be treated as a partnership when it comes to taxes. Majority of you are S Corp owners. So there's a different tax treatment and there are different tax saving strategies that work for multi-member LLC partnership that will not work for an S corporation, right? And so we have to make this decision and figure out what works for you. So just, a takeaway from this, you don't want to waste too much of your energy on receiving all of this overwhelming public information about tax saving strategy. Unless you really know what your situation is and what works for you, then you really want to narrow down your research um, onto that specific tax saving strategies for multi-member LLCs or S corporation or etc. Third item, compare to cost and benefit, right? Analysis. So obviously, you don't want to pay $1 to save a quarter. I think Dave Ramsey said this a few times too. And one of the worst tax advice that I've heard is, hey, why don't you go ahead and buy like, you know, a computer or something at the end of the year, even though you don't need it to save some money on taxes, right? Would you spend $1,000 out of your pocket to save $20 in taxes, right? Or would you pay or 200, or would you pay $200 in tax and save $800 in cash in your pocket? You know, a lot of these decisions have to make sense, right? If you really need a computer to operate your business and grow it, by all means, go ahead and make the purchase. But why would you spend $1,000 in order to save $200, right? Wouldn't you rather have $800 in your pocket? So cost to benefit, analysis is very important. And that cost sometimes is not only money, right? Sometimes it's your time, uh, and also it's your effort and it's your energy that you have to put in to make that worth. And a lot of the times it's actually worth a lot of the investments and time and the money that you put in, right? The last item here is monitoring your tax saving strategies, right? How many of us had a very intense discussion with your CPA or tax professional at the end of the year? Hey, man, why did I have to pay $40,000 in taxes this year? What can we do about it this year? And your accountant tells you, well, you got to start doing accountable action plan. You got to start doing Augusta rule and you need to start doing this and that. Well, how much of that discussion actually is happening today in your business? Did you implement that tax saving strategy? Is it actually happening? Is your deduction really growing this year from the tax saving strategy? Are you monitoring and are you assessing it, right? So for me right now, today is December 9th. So by now I've already finished approximately 90% of our clients' tax projection, right? So we meet our clients twice throughout the year, and that's my requirement because it's really hard to get a hold of my clients. I make it a requirement to meet with them at least twice a year. The first meeting, obviously, is taking place after the tax season, May or June time, and that's really when a lot of the questions come up. Hey, what happened here? What can we do to make this year better, right? And so if you're planning out for 2024, that plan should start back in May to June in 2024, and you build a plan, right? What can we do this year? What can we do to catch up, do something different? Is our entity structure formed in the wrong way? All of that questions are addressed in May to June time. We build a strategy in writing and we start documenting everything. Obviously, without documentation, a word of mouth is really nothing. So we start having a well documented tax planning, and then you start implementing, right? Okay, are we going to do a Augusta rule? Okay, well, when are you going to rent out? When are you going to hold these corporate meetings at your house, right? What are the dates and how much are you going to pay? What's the market rental rates, et cetera, et cetera. So actually implementing, scheduling, and making it happen. And the second meeting takes place in October to November is when we start asking, okay, all right, are we actually doing this to begin with? And is it working? Well, it should work. And that question should have answered on the first meeting. And the third question is, okay, approaching the end of the year, what's the tax liability that we're expecting this year? Obviously, we can only project so much on the future revenue of our businesses, and I'm sure it depends on the industry as well. So by November or October, you have a good idea of roughly how much of the year-to-date estimated taxable income you're going to have, right? So we make an assessment. We make a yeah, we make a projection of the year end. So that's where tax base. So really, I just gave you a good timeline of tax planning and how it takes place, right? And this cycle happens throughout the year. Every single year, two meetings, build a new strategy, run a new reasonable compensation analysis, and compare and contrast. Okay, how are we doing this year and next year, right? And sometimes, I have clients who have a perfect setup for tax strategies and doing very good in tax strategies every single year. And by the third year, you're not going to have drastic tax savings because you're already saving a lot of money on taxes, right? That's where you want to be at. And by then, you're on a cruise control. But we're still keeping our antennas up with, constantly changing tax laws, and we're making new strategies every single year. So, uh, okay, let me see here. Okay, before we move on to the next slide, I want to take some initial round of questions here from the audience. So, looks like,
Okay.
yeah, go ahead. Yeah, David.
I'll go ahead. I'll go ahead and unmute. Okay, go ahead. Go ahead.
Thank you. Okay, so I see the
Oh,
first question asked here, David, on the Q&A box.
Mr. Patel, go ahead. You're unmuted.
Hey Tay, this is Jay here. Hope you're doing good, guys.
Hi, hi.
Yeah, so I had this question. See, I'm probably like moving into this thing like soon. We are in process of like. So my question is like, okay, as a customer, can you give us an example of like some scenario of tax saving strategy as a, like we are a newbie in this thing, like okay, that we can foresee like okay, take and help in this kind of situation. So if you can give us like few example of scenarios that you have helped your previous client as like beginners, like what would be that?
Yeah, yeah. So, um, I mean, I'll give you an example. Obviously, I can't do a full-on tax planning session on you on this call, because I'm lacking a lot of information right now. But most common situation is S corporation owners, right?
Yeah.
Uh, this particular client of mine uh, has been running a therapy counseling business, and they're generating roughly 3.2 million gross every year and roughly 4 to 500,000 net every year. Now, he's been running his business for approximately 15 years, and over the years, he received some tips from some people uh, that he needs to elect to S corporation, right? And he did elect S corp. Prior to that, he was a single member LLC, and he's been paying a significant amount of self-employment taxes, right? And now, self-employment tax is not entirely a bad situation because part of that money goes out towards your Social Security account, right? And you receive the Medicare benefits and et cetera, et cetera. However, excessive amount of Social Security tax withholding and Medicare unemployment insurance, I mean, that's what all the 15.3% self-employment tax goes out to cover that. So he elected S Corp, but he really haven't done um, the reasonable compensation analysis. And what that really is if you're an S corporation and you don't want to pay any self-employment tax, IRS says, well, you still need to pay some sort of a payroll to yourself in order to qualify for the S corp status. Well, I mean, if you're an S corp owner and you want to pay a payroll to yourself, then you want to pay, the least amount of payroll, right? This particular client thought, hey, I'm in the medical profession, and so, I think, roughly 200,000 is a solid payroll to pay myself. So he started paying a very high salary to himself. Now, then we come in and we do the reasonable compensation study based on, and the IRS has their preferred method of figuring out a reasonable compensation amount that has been released from court cases. And these court cases were on the S Corp owners who started paying themselves a salary from payroll, but they didn't document how they came up with that salary amount, right? So when that happens during the audit, IRS is going to calculate their own estimated compensation amount. And so we take the same approach that the IRS does as if you were getting audited, and then it's documented, right? And so from the reasonable compensation study, your payroll should have been $135,000, not a $200,000. So there's a tax saving on the $70,000 that you don't have to run a payroll on, that you don't have to pay a payroll tax on that difference, right? So having a reasonable compensation study analysis alone, there's a tax saving there. The second part is accountable action plan, right? How many of the S Corp owners have heard accountable action plan? Can we maybe raise a hand on your poll there?
I don't even know what is that.
On the
Okay,
bottom of your
great.
screen, guys, there's a button that says raise hand. So if you hit the raise hand, then Tae can do a quick poll.
Yeah. Thank you, David. I know there's about, I believe, 4 S Corp owners here on today's call. So, and I'm very surprised that not a lot of people heard about this. Accountable action plan is specifically for S corporation owners, but also C Corp owners can utilize this as well. Now, if you're an S Corp owner, you most likely are using a lot of your personal resources to run your business. You get some job done at home, you have a specific home office, you drive your wife's car sometimes, your family car, your own car, the auto mileage, and it happens, right? Um, what usually happens is people who become an S corporation, before becoming an S corporation, you were a single member LLC or a sole proprietor at the time, right? And so when you're a sole proprietor or single member LLC, what happens is in your personal tax return, you simply fill out a form that says, my office square footage is X amount, total home square footage is X amount, give me a home office deduction. Well, for the mileage, you're going to also do the same thing. My business miles is this, total miles is this, give me a mileage deduction. Once you become an S corporation, you no longer file a tax return at the personal level. You have to file a tax return on its own S corporation standalone tax form, 1120S. And on the 1120S, you don't have a separate piece of form there to attach to elect for in home office or auto mileage deduction. But instead, what you should be doing is you should actually reimburse yourself the mileage deductions and the use of a personal home office deduction. And so it's not a deduction that you simply elect, it's a deduction that should actually happen throughout the year in the form of a transaction, right? And so what IRS wants you to do, especially for the S Corp owners, if you're an owner and an employee of the S Corporation at the same time, you can abuse the system, right? Because you're owner, you have control over the bank account. You can transfer whatever money you want and simply say, hey, you know what? I'm reimbursing myself a home office expense of $200,000. Awesome, right? Well, you can't do that. So what IRS wants you to do is they want you to follow the steps really as if you hired like an actual employee. So picture yourself as an employee of a business. You need to submit an expense report along with the copy of the receipt, all the supporting documents. If you drove from point A to B, then you give them a mileage log and say, hey, these are the miles I drove for this month or this quarter. Please pay me back 67 cents a mile. And my reimbursement for this quarter is $6,000 and some change, right? Then your business actually writes you a check for $6,000 and some change to you, to the employee. Now, you're killing two birds with one stone here, Mr. Patel, because what's happening is the first bird that you're killing is you have a deduction of a mileage and home office expenses that you never had in your S corporation, right? So you have a lower taxable income at the S corp level. The second bird that you're killing is, oh, now you have extra $6,000 of cash in your pocket from this reimbursement program you were participating. And guess what? It's a reimbursement. And IRS tax code says reimbursements are not a taxable income to you. So now you have extra $6,000 of money on your hands that you don't have to pay any tax on. On top of that, you have $6,000 less in your taxable income for your S corporation, right? And so this is the most common tax strategy that a lot of my clients are missing out on. It's kind of the meat and bone in a lot of the S corp owners' tax strategy that we're implementing for them.
I already like you. I'll see you soon, man.
Yeah, thank you. Yeah, really, but my goal here is, we need to make sure that the tax strategy works, right? And so, accountable action plan is one of the main thing. Reasonable comp study. And the third item I want to mention to you is documentation, right? I've had a case where a client was getting audited by IRS, and they say, hey, you pay $1,000 to whatever church. Do you have like a supporting document, letter, or some kind of a receipt? And the client gave him a copy of the letter, like, here we go. And IRS agent said, great, perfect, all good to go. The second case, they asked for a similar documentation, and the client came to me and said, hey, Tay, you know what? I don't have any documentation here. Um, it was a contractor payment. He paid someone through Zelle or something, right? And I asked the client, well, what did you pay this person for? And he said, well, I hired this guy to do my office, like, lawn work here. Well, okay, well, then that's a contractor payment. Do you have a contractor's agreement with this person? That shows how much the compensation is going to be and what type of work this person did. He says, no, I don't. Okay, well, can you contact the contractor and ask him for a copy of the invoice to be sent to you right now? And IRS already knows, that, okay, these people are now drafting putting together supporting documents. So they have a higher suspicion, and there will be even closer monitor, and they'll review even more on that type of documentation that has been put together at the last minute. So, a lot of the S Corp owners, especially as business owners, I mean, let's all admit, how much time and energy do we actually put in to put together proper documentation for our deduction? So, one of my main mission is to help my clients have proper documentation, especially with accountable action plan and the reasonable compensation. So, yeah, that's my part. I got a little extended here, Mr. Patel, but I hope I answered your question.
Oh, you did. You did. Thank you, Tay.
And Tay, you know what? Or actually, this is for everybody. I love Tae's approach here because, when it comes to tax planning, a lot of people, from my perspective, are like, there's this secret strategy that nobody knows about, and it's super complicated. And so we're gonna, pump a bunch of time and money into this like advanced thing. I mean, sometimes there are more advanced strategies you need to execute, but we always want to kind of start from the ground up, right? Like, for example, I met with someone that 100% of their compensation from a business, from a corporation, was W-2. 100% of it. They were taking no draws, no distributions, no nothing, right? So it's like, this is a basic thing that they're basically hurting themselves from not doing it correctly. So, it's pretty straightforward, but it can have a big impact, especially if this goes on for years. You know what I mean? So thank you for going through that, Jay. I appreciate it.
Yeah, you're welcome. I have a few more slides. Are we doing okay on time, David? Okay, all right. Let's move on to the next one here. Um, well, I guess I already explained this part here, but I'm a very, very true believer that tax planning is not a one-time thing. It should happen at least twice a year, right? Number one, to build a plan around May to June time, and number two, to monitor and implement and assess, is it really happening? And also, I guess the most important question that many of you are wondering, is it really saving you money, right? So that's, the second meeting here, you will really see what's happening here, right? And uh, so the best time to build a tax plan is unfortunately not during the tax season. Um, and and the reason why I make kind of a drastic pause here is because I personally experienced working with my clients that clients who do not do tax planning will have one of the worst times, like February, March, and April is the worst time of your year, especially if you're a business owner, right? Unless you plan ahead, you save some funds aside to cover the taxes, or you pay quarterly estimated taxes. If you're not doing any of that, you're almost guaranteed that you're going to pay some amount of tax bill during the tax time, right? I have clients who come to me in the middle of the tax season, hey Tay, I don't like the result here. What's happening? What can we do about it? Right? Unfortunately, that is not the time to address the questions at the time. And I feel for a lot of other CPAs, enrolled agents, and tax professionals across the whole country, because we're making a living here, right? And we want to get through as much tax returns as possible. We're cranking out, we're staying up very late, showing up early in the morning. Everyone's working long hours to get all the returns out of the way. And so really, just from a realistic standpoint, we just don't have the energy to give you the right resources and the right advice on exactly what you need to do to save money on tax, right? So the tax return filing season is simply a tax return filing season. So tax planning should happen before you head out to Hawaii after the tax season, right? Before you take the summer off, take some time to meet with your tax professional, ask the questions, and I almost guarantee you that they will give you a far better answer that they could have given you during the tax time when you asked them in the middle of March. Yeah, in the middle of March, in the back of their head, they're thinking about, okay, how can I quickly answer and move on to the next tax return, right? Obviously, then that's a different priority at the time. So that's kind of a little topic about the tax planning there. David, you okay on the questions so far?
We're doing good. I'll let you know.
Okay, perfect. Thank you. Okay, all right. I believe I have given you a very good information and picture about what tax planning is and how it takes place. Discussing the actual strategy itself, I believe is for some other time, and I'll be very happy to discuss privately outside of today's webinar, because like I said, we need to assess your situation, what type of entity it is, and we need to figure out what tax planning actually works for you. Okay. I have received a very special request from David this morning before walking into the office, and his question here, and I heard that this question was brought up a lot by a lot of the audiences here, especially as the S Corp owners and clients of David Shoup's office. And so the question that came up a lot is, hey, I own a house. Can I rent my personal house or even house or property, personal property, for business use and deduct money and save money on taxes, right? So I'm going to address this question, and hopefully I give you a very good picture on your takeaway. So general rule, we'll start from the general rule here. If you received income, it's a taxable income, right? And that includes rent, right? And so if I have an S corporation, I operate out of my garage, I pay myself $6,000 a month rent to take him as an individual for running my business out of the garage. Well, you have a $6,000 a month deduction on your S corporation. Awesome. Now you're saving money on taxes. Well, not exactly, right? Because now all of a sudden you have a rental income at the personal level for $6,000 every month. So in that specific scenario, you are not saving a single penny on taxes, right? You could, yes, you can deduct mortgage interest, you can deduct utility bills, et cetera, on your personal home office. However, you could have been doing that through accountable action plan, right? And that reimbursement that you get from accountable action plan, you don't have to pay tax on that. That's not a taxable income either. So I would personally not do the first scenario here, but instead take advantage of the accountable action plan here. Also, one more important part to remember. I want to share a brief story here. I had a client who created an S corporation in order on his rental properties, and it sounded very nice and fancy in the beginning, but as I look at it, I personally don't understand why he created an S corporation on rental properties, because the whole purpose of creating an S corporation is to be exempt from paying self-employment tax. Well, self-employment taxes are only on the earned income, okay? Not on the passive income. So your rental incomes are passive income. So your rental incomes are not taxed to self-employment tax to begin with. So he went the longer route to create an S corporation on something that would make no difference. Matter of fact, he paid money on bookkeeping, he paid money on tax return filing fees, on payrolls, all those various expenses, let alone all the admin and all these, professionals trying to get, your questions on the overhead and administrative work that you have to do, right? So it wasn't worth it. Okay, so that's the first scenario. The second scenario is Augusta rule, right? We've heard this Section 280A tax saving strategy from TikTok, Instagram, YouTube, a lot of the folks. All right. And what's funny about this Augusta rule is it only works to a very, very specific clients. I've had a client who wanted to elect Augusta rule, and so we went ahead and did it. What Augusta rule says is, okay, you can rent out your personal home to do business in either corporate meetings, business events, or meet with your clients, et cetera, right? Now, earlier I said if you made income, it's taxable. However, IRS says, well, we'll give you guys a little break here. And if you rent it out for 14 days or less throughout the year, we won't ask for tax money, right? So Section 280A, Augusta rule came on the books, and we started putting things together. The client told me that he held a week-long business event at his personal home twice a year. All right, great, 14 days, perfect. I asked the client, hey, can you send me your market rental rate, right? So because that's how Augusta rules work is your rent cannot be whatever abusive amount that you decide to, $6,000, $7,000 a day, you can't do that. It has to be reasonable. It has to be a fair market rate. And so, you can do a quick market research. Nowadays on online Zillow or Redfin gives you a market estimate of your rental amount per month. So client went ahead and pulled a report and gave me a monthly rent on his house. Well, it turns out it's $2,100 a month. So then, okay, well, there are 30 days in a month. So we take 2,100 divided by 30. That's $70 a day. Okay, well, client had meetings for 2 weeks. So that's 14 days. Awesome. All right, we're writing off $980. Oh, by the way, you're in a 22% effective tax rate. Your tax saving for doing all this work was $200, $215 here. And client is operating, a real estate business, and by doing all this, he invited clients over, had a takeout meal, did all this to save $216 in tax savings for Augusta rule, right? Is it really worth it or not, right? So, in my opinion, it has to make sense. The cost and the savings has to make sense to your perspective, right? To your situation. So, Augusta rule was another commonly discussed tax strategy when it comes to renting out your personal home. Now, the third item here is a corporation rental strategy. This one's a little different. And this happens mostly on commercial property owners. And so if you own a commercial property, by the way, everyone, kind of brace yourselves because this whole topic is very good. At the same time, it can be very boring to hear. Uh, but there are some qualifications that you need to meet in order to really benefit from this strategy. Number one, you need to be a C corporation, not an S corporation, not a pass-through entity. And the reason for that is because if you are a C corporation, you pay a corporate tax, not a pass-through tax, but you pay tax at the corporation level, right? Double taxation. However, Tax Cuts and Jobs Act set the corporate tax rate at a 21% flat. Regardless of what your income is, you're paying clean 21% corporate tax rate. So then everyone wants to become a C corporation. And so what IRS did was, okay, you know what? I don't want you to abuse the system. So if you're a C corporation, you need to issue dividends, right? Because that's how shareholders of the C corporations receive earnings by receiving dividends, aka owner's draw to S corporation owners, just to help we all understand to get a better picture here. So now, let's say you're a C corporation, you made $500,000 net profit, net income, and IRS thinks, hey, you know what? You're hoarding too much revenue there to take advantage of the tax benefits of a C corporation. So then they started they created this rule another tax item here called accumulated earnings tax, right? AET. So what that is at the time of an audit, IRS will decide how much of the $500,000 was an unnecessary accumulation of earnings that you decide to keep at the corporation level to save money on tax. Okay? And so it is IRS's responsibility to prove, the burden of proof is on the IRS to prove that what is unnecessary amount of accumulation of earnings, right? Generally, they look at 2 to 3 months worth of operating expenses, right? So then let's say your monthly operating expense is 50 grand. Yeah, let's just say that. Then if you held more than $100,000, then what IRS will say is on the excess $400,000, you have to pay an additional investment income tax on the $400,000 on the accumulated earnings. And that additional tax is taxed at 20%. And that's as of today, right? So you paid a 21% corporate tax on 500, and now you also paid a 20% accumulated earnings tax on the 400. I mean, tax is going left and right at this point, right? So uh, one strategy that came up to the folks in that specific situation was I'm going to use an example here for dentist because one of my clients is a dentist running a dental office. He purchased a dental office property, commercial property, under his personal name or his family trust. And his corporation pays a rent for using his dental office building to the individual, which in turn becomes a rental income at the personal level. So he pays tax on that, right? However, paying off the rental expense at the corporation saves you from paying accumulated earnings tax penalty of 20%. And also, you deduct all the operating utilities and repairs and maintenance expense at the personal level against the rental income. And so when comparing the amount of tax saving and the amount of tax that you have to pay for becoming a rental owner at the personal level, uh, you know, in this particular client, that strategy worked, right? And so this is a third example that you could take advantage of for a corporation rental strategy. Uh, and I know this last one was very specific and very narrow, but that's how really tax plannings work. We build a plan that works specifically for the client. We interview extensively. This that interview, we don't do it every single year, obviously, but we get to know the situation, et cetera, et cetera. So that is all of the rental strategies that I wanted to discuss today. I'm sure you've heard of all the short-term rentals, the Airbnbs, and all the things you can do. That's not really a separate rental for your business owners, right? That's mainly for W-2 earners whose hands are really tied and you can't really do much about saving tax, so you're just trying to create some more losses to offset the taxable income there. Davey, how are we doing good how are we doing on time?
Yeah, good. I think if we
Okay.
move into the Q&A stuff in a couple minutes, we're looking pretty good.
Okay. All right. Let me go ahead and discuss a few important reminders I wanted to share with the business owners. And trust me, I'm not going to talk about BOI. I'm sure you've heard about that reminder millions of times from Mr. Shu already. So I'll keep that as not my place. Number one reminder I would like to remind all the business owners here. Stay proactive instead of reactive, right? And if you need help, speak to your tax professional during the year, not during the tax time, and we can really help you, right? We can really stay on top of your game and hold your hand throughout the year, answer your questions, and we have resources, right? We have I receive a monthly newsletter, weekly newsletter directly from the U.S. Treasury Department on the ongoing tax law changes and potentially tax bills that are under review by the Congress. I'm not going to comment on what the candidates said about what they're going to do when they take place in the office here. Obviously, that a lot of that can change. So yeah, I highly suggest everyone to do very best to stay proactive. The second item here, as much as it sounds so simple and basic, I have seen kind of like a growing number of folks who don't take bookkeeping seriously. And, I'm not particularly saying this because I'm trying to get bookkeeping clients out of you today, but I really want to help you to make sure that you really review your financials, you look at how your business is doing throughout the year. And without a bookkeeping, you have nothing to look at this point. You have nothing to build your tax projection. You have nothing to build your tax planning on. And, at the end of the year,
what could potentially happen is, March 15 is your corporate tax return deadline. Well, how are you going to put together a year-long bookkeeping in 2 months? Let alone if you hire someone to do that, I'm sure that'll be a lot of money too. So, you file extension. Well, obviously, personal returns have to be filed extension, and now you're late, right? So I highly, highly recommend everyone do some research and market, search, shop around your bookkeepers, really. And there's a lot of good help out there that you can get to get your bookkeepings done throughout the year, right? And I highly recommend doing this at least monthly basis, that you review your financial statements monthly closely. Uh, and I already mentioned about documentation, so we'll mention that. Uh, uh, Tax professionals, we're not IRS agents. We're someone to help folks like you to address your concerns. And so don't be scared to reach out, right? I had a client who only calls me when he's making money, and he doesn't call me when he's not making money. But, honestly, just because you call my office doesn't mean we charge, right? Nowadays the billing structure is all different. And so please don't be afraid to reach out to tax professionals to address your concerns, to talk about, anything that you need to discuss, and also, sometimes just simply giving us an update on what's happening in your life is very helpful. It helps folks like me to stay prepared. And, I tell my staff and I tell my team, okay, well, my client, this is happening. Let's get ahead and get ready for this for the tax time. So it's very helpful here. The last one here, I discussed briefly in the beginning of the call here, but again, don't let the tax situation consume your life, right? At the end of the day, your quality of life is very important, and you don't want this to really drain the whole energy out of you. So utilize, professionals, tax professionals as much as you can. And obviously, the cost and benefit has to make sense, like I mentioned multiple times throughout the call. And so don't let the tax situation consume your life. I wanted to mention briefly about IRS, not to tell anything bad about IRS, but IRS need to get paid, right? They wanna take, if they need to collect money on taxes, you know they need to make sure you're doing well. You know what I mean? They need to make sure that you're happy, you're surviving, you succeed. When you succeed, I and I'm talking from IRS perspective, not from my me or my client's perspective, right? So IRS wants you to be happy, and so um, you know on the very, very rare unique cases, if you really ignore IRS to the very end of the day, then the enforcements happen. But as long as you stay in touch with them, you let them know what's happening. And CPAs and tax professionals like myself, we have resources on how to get to IRS and explain your situations to them. I had folks who lost a family member and all that. Due to that reasons, they were not able to file or pay tax returns, and they just can't keep up with it, right? You can file a settlement. There is all different ways that IRS is willing to work with you to help your situation, right? Because I mean, if they ruin your life, they're not going to get their tax money paid. So that's not their strategy. So don't be scared with with IRS. I would actually be a little scared with California State, David. I'll tell you that because they're so aggressive. California and New York states are two of the most aggressive states in the whole country. And any type of assets, bank account, anything that shows up on their radar, I mean, they'll really seize that. So my recommendation to everyone today is, if you receive any notices, letters, please do not ignore it, right? And you just simply give them a call and let them know, hey, I got this. We're working on this. We'll get back to you. And you work hand in hand with them. Yeah. I mean, I don't know how many of us are running running behind on taxes, but just wanted to put that out there because there's a general image of IRS that everyone just hates. And I'm not an IRS agent, by the way. I have to say this again. But yeah, don't be afraid and yeah. So I believe that is it for today. I want to share briefly about my tax assessment, and if you like my presentation, and if you like to sit down with me to review your whole tax situation, I don't only look at your personal, I also look at your business ventures, partnerships, side gigs, any sole proprietorships you have going on. We review it all together. And then I give you a full write-up of the tax analysis to you on which areas that you can potentially look into to save money on tax. So, I mean, we're charging an initial fee here, 500. But honestly, if you would like to go with us, then we can apply that on the actual tax planning fee, and there's different ways to work on this. But yeah, if you would like to work with me here, sharing my contact information on this screen. And also, you can reach out to David's team to get my direct contact or my office number as well. So, with that in mind, thank you all, and I really appreciate you taking this very, very. I'm sure we're all busy here. So, and David too, I appreciate you taking the precious time to allow me to take this time to share my thoughts here on tax planning.
All right. Awesome. Well, thank you so much, Tae, for really going through this. And I love how you started again. It always starts with the foundation, right? We've got to make sure that everything is really structured really properly, and giving everyone an opportunity to sit down with you and just get a complete assessment and evaluation of their businesses. I mean, that is 500 is nothing, compared to the value that you can get from that kind of a session. So I'd highly recommend you guys to take advantage of that, so you have actual concrete assessments, strategies, etc., in place that will make a significant difference. Because I know you guys on the call here, and I know some of you, your net is going up, and that's awesome, right? I love it, right? But you got to make sure you have the strategies in effect so that your tax liability goes down, as opposed to spiking up and just taking all of your profit that you're building. So 100% recommend that you reach out to him. And then those of you that are on my maintenance plan, if you would like to do this together so that we can join, I can basically provide my insight and kind of my thoughts and that kind of stuff along with Tae. Happy to do that. That way this meeting is even more effective. Totally up to you as far as how you want to do that, because everyone on my maintenance plan has that session included. So guys, with that in mind, if there's any other questions, either raise your hand or type it into the Q&A, or put it into the chat and we can jump on. If there's no other questions, then that's it for today. And thank you so much for joining. But me and Tae will hang out for a couple minutes in case there's any questions. But thank you so much, you guys, for joining. Hopefully this is really helpful for you guys, right? And understanding some of the basic stuff and how you can really leverage this moving forward to reduce your tax liability.